The final topic is on equity securities, which are stock investments. We journalize stock investments based on the percent ownership. We have already covered the entries when less than 20% of the company's stock is owned. This was the fair value method, otherwise known as a cost method. In this topic, we will be covering the other methods. We will spend most of the time on the equity method. This is when you own between 20 and 50% of the company's stock. Even though you do not have controlling interest, you own enough to have significant influence over the company. We will learn these journal entries on the next slide. The final category is when you own more than 50% of a company's stock. This is when you do have controlling interest and you essentially own them. In this case, you will prepare consolidated financial statements. As mentioned earlier, we are not going to be preparing consolidated financials since this is an advanced accounting topic. However, I will briefly go over some terms and definitions. Let's begin by looking at the journal entries under the equity method. Remember, the equity method is used for stock ownership of 20% to 50%. The first step is to add the investment to our books, similar to the fair value method. Instead of using the account stock investments, we use the account equity method investments. This is an asset account. We credit cash because no matter the method, we are still spending cash to purchase these investments. The next part is where it gets a little tricky. We're going to account for any dividends received a little differently than under the fair value method. When our investment pays us dividends, we do record this as cash. However, the credit is not dividend revenue. Instead, we credit the equity method investment account. We are essentially lowering the value of our investment. I want to use an analogy that may help explain why we do this. Let's say you have a checking account and a savings account. Both accounts are yours. If you transfer money from your savings account to your checking account, then your checking account received money and the value of your savings account decreased. Since you own this other company, which is your investment, and your investment gives you money, then you did receive money. However, your investment just spent the money, which means it went down in value, like the savings account. Now, the amount for this entry is only the amount that we are receiving in dividends, not the total dividends they are paying out to everyone. It's only your share or your percentage. For example, if I owned 30% of a company, I will use the amount for 30% of the dividends they are paying out, my share only. The next entry is to record our share of earnings. When the investee reports its earnings, the investor, which is us, records our share in our investment account. For this entry, we're debiting equity method investments and crediting earnings from equity method investments. Using the checking and savings account analogy again, let's say your paycheck got direct deposited into your savings account. Well, didn't you just earn money? Didn't the value of your accounts go up? Yes. Even though your income was put into your savings and not your checking account, your income still increased because you own that. Same thing here. Your investment earned income, you will account for your share of that. We're going to practice these entries now. This is number 4 on your classwork. Montero Co. holds 100,000 common shares, 40%, of ORD Corp. as a long-term investment for $1 million. ORD Corp. paid a $100,000 dividend on November 1st, 2017, and reported net income of $700,000 for 2017. Prepare the entries to record the purchase, the receipt of the dividends, and the December 31st, 2017 year-end adjustments required for the investment account. So first, we need to put the investment on our books. What is the name of our investment account? It would be equity method investments. How much is our investment worth, or how much did we spend to buy it? $1 million. Do you remember the credit? It's cash, and the amount remains the same. This first entry is pretty simple. Next, on November 1st, we want to account for the dividends they are paying us. What are we actually receiving? We are receiving cash. How much cash? Well, the company paid a $100,000 dividend, but remember, we only account for our share or percent ownership. How much do we own? We own 40%. 40% of $100,000 is $40,000. Next, we need to revalue our investment so as to not double dip by gaining one asset and not reducing the other. We need to bring the value of our investment down. Remember, this is like transferring money from one account to another. We credit equity method investments for the same amount. Now, the last entry is to recognize our portion of their income. Remember, this is like having a deposit come through in one of your accounts. We need to bring the investment up in value because they have earned money. We debit equity method investments. How much would it be for? Remember, it's only our share. We multiply our 40% ownership by their net income of $700,000. You should get $280,000. Our credit would be the revenue account, earnings from equity method investments. The amount is the same. These transactions get a little tricky. It's important to remember that the account equity method investments is used for each journal entry you are making here. And remember, these are only for stocks that you own 20 to 50% of. The last point I want to bring up is on consolidated financial statements. Remember, this is when you own more than 50% of the stock. This means the investor has controlling influence over the investee. A version of the equity method is used, which is the consolidation method. The controlling company is the parent company. This is the company that bought the other one. The investee company is called a subsidiary. This is the company whose stock was bought. The investor reports consolidated financial statements, which shows the financial position, the results of operations, and cash flows of all entities under the parent's control. For example, the parent company Yum Brands owns several subsidiaries, including KFC, Taco Bell, and Pizza Hut.